You've seen this happen, right? Some crypto token you've barely heard of suddenly just goes vertical, and your entire social media feed erupts into a war between the bulls and the bears. Well, today we're going to deconstruct one of those moments, the absolutely chaotic surge of a token called STO, to really understand the powerful forces that are pulling the strings behind these wild market swings. So, on March 29th, this happened. The StakeStone token, or STO, shot up by almost 45%. Now, in a market where even a 5% move gets people talking, something like this, it grabs everyone's attention and basically forces you to pick a side, and fast. And just like that, the bull case exploded onto the timeline. You had traders like Fibonacci Flow calling it a nuclear derivatives squeeze. Now, that's a wild scenario where people betting against the token get so squeezed they're forced to buy back in, which, get this, just pushes the price even higher. To them, this was a screaming signal to jump on the rocket ship before it was too late. But, and this is what's so fascinating, at the exact same time, another whole group of traders looked at the very same chart and saw the complete opposite. They saw a trap. They saw a reversal play, the perfect moment to bet against all that hype, convinced that anything that goes up that fast is about to come crashing right back down. So, who was right? Well, it's not that simple. Okay, so to really get to the bottom of this, we need to cut through all that noise. Let's start by looking right past the social media shouting match and just break down the hard numbers behind this whole frenzy.
And believe me, the numbers were staggering. The price didn't just climb, it literally leaped from about 11 cents to over 16 cents. Trading volume just ballooned to more than $78 million. But look at that third number, because it's the really crucial one. Open interest. That tells us the total value of all the bets on the token's future price. And when that soars to $146 million, it's a huge signal that this price move isn't just about people buying the token, it's about a massive amount of high-stakes, leverage gambling.
And that brings up a really important question. You know, with all this money flying around, what even is StakeStone? What's the actual thing being traded with so much intensity? Is there any real substance here, or is it all just speculative chaos?
Well, at its core, StakeStone is what's called an omni-chain liquidity protocol. Just think of it like a super express network for crypto. Its entire job is to let your digital assets and your money move easily from one blockchain to another, which honestly solves a massive headache in the crypto world.
And here's the surprising part. Unlike a lot of the tokens that get these crazy pumps, StakeStone actually has some seriously solid fundamentals. We're talking $1.3 billion locked in its system, more than 330,000 active users, and it's backed by some of the biggest names out there: Polychain, Binance, OKX. This is not just some random meme coin.
So its main products actually let you use liquid, ready-to-go versions of big assets like Ethereum and Bitcoin that are earning yield. This means you can earn those staking rewards while your money is still free to use somewhere else. It's a genuinely useful tool. So if the project is this solid, what's with the insane volatility?
Well, the answer is really in the anatomy of the price surge itself. See, this wasn't just one type of buying going on. It was a full-on battle between two very different forces in the market. So on one side, you have your spot buyers. These are people just buying the actual STO token, probably to hold it. And that usually creates a slower, more gradual price increase. But on the other side, you have derivatives capital. And these are traders using borrowed money to place huge bets on where the price is headed next. And that is like pouring gasoline on a fire. It's what fuels these incredibly explosive price swings. And look at this. This chart just illustrates the point perfectly. The data shows these two massive, totally abnormal spikes in hourly trading volume on Binance. I mean, they're completely dwarfing the typical volume. We're talking almost 1 million STO tokens traded in a single hour. This is not your normal everyday buying and selling. This is a frenzy. And here's the final confirmation. That open interest, all those leveraged bets we talked about on just 2 exchanges, hit a combined $146 million. A pile of money that big creates extreme volatility, because when the price moves against these big positions, it can trigger a domino effect of forced selling or buying, leading to those violent squeezes everyone was talking about. So this is where we need to zoom out a little bit from just STO and talk about a lesson that applies everywhere in crypto. See, a lot of the time, these explosive, volatile moves, they aren't totally random. They can actually be part of a playbook used by professional traders to profit from everyone else's excitement. Yeah, in these markets, you have these huge players. We're talking whales, giant trading firms, sometimes even the exchanges themselves, known as market makers. And their job isn't just to make trading easier, their job is to make a profit. And one of the ways they do that is by deliberately engineering price action that traps enthusiastic but maybe unprepared retail traders.
And they've got a whole bag of tricks. They can create fake breakouts to suck people in right before they reverse the price. They can trigger everyone's stop-loss orders in what's called a stop hunt. They can trap you in a frustrating price range for ages, or even use a big news event to whip up a frenzy right before they dump all their tokens. Now think back to this quote from earlier. Hold the breakout. This is the exact kind of thinking that fuels one of these traps. That call to action is precisely what market makers want to hear. It's the emotional fuel that brings in all the money, all the liquidity that they need to trade against. And the most common trap, especially in a situation like this one, is the fake breakout. Here's how it works. The market maker pushes the price just past a key level. That triggers a flood of buy orders from people who think the rocket is taking off. But as soon as all those buy orders are filled, they slam the price back down, leaving all those new buyers trapped in a losing trade. So this all leads to the billion-dollar question, right? How can you tell the difference? How do you spot a potential trap before you become the liquidity for somebody else? Well, let's build a quick toolkit for that. Okay, here are a few simple red flags to keep an eye on. For a fake breakout, the biggest giveaway is when the price surges, but the trading volume is really weak or even declining. A real move has conviction behind it. For a stop hunt, look for a sudden, sharp, violent price spike on the chart that instantly reverses. And for a news-driven pump, check to see if the underlying indicators are actually confirming the move. If they're not, it's probably just hype.
Ultimately, this whole STO saga is a powerful reminder of the game we're all playing in. This is a market that is filled with highly sophisticated professional players, so it leaves us with one last, really critical question we all need to ask ourselves. Are we trading with our own well-thought-out plan, or are we just becoming a part of theirs?